We're in our Excel sheet now, and I just copied the sheet, except we're going to change a few assumptions. We changed this assumption, which went from 90 to 89.5, seemingly small, it's 0.5%, but it's times the biggest number, sales. Second one is that we're going to change inventory. We went from 20 to 16, being a little better at managing inventory. If those are the only things we changed, and we kept these sales projections the same, which were 10, 8, 5, 5, then what would happen? Well, we have these projections, and beauty of spreadsheets, we just pop in the variables and see what happens. And when we go down here to some of the measures on free cash flow, net operating working capital changes, fixed asset changes, etc., and we end up with this. Free cash flow is improved. We're still negative here in terms of our growth. We went from 82 down to 23, but our ROIC went to 9.2. You'll recall that the WACC was 9.0. So these changes, two changes, and perhaps we could have been more aggressive, changing more of the operating items in the income statement or other asset assumptions, but just changing two got us to a point where ROIC exceeds WACC. So that's an accomplishment. So go back to document, and the 9.2 is better. If we now look at the intrinsic value, the WACC is the same, growth rate's the same. We got to this number, which is the new horizon value. Since we're growing and since our free cash flow has also been better, the ramp up, we now have 1597. The NPV, same method we did before, gets us 1313. We still have no money in investments, same beginning balance sheet. And then we pay off our debt, $500, and we now have 813. Divide that by 10, it's $81. And you recall that, or maybe not, but I'll just remind you, our stock value was 45.75. So now we're doing well. Our ROIC is 9.3, bigger than 9.0, and our stock price is, or projected stock price would be $81 versus 45. So you can keep your job, right? We've done some value add. So if we look at the balance sheet, I'll just stay here. You can see the Excel later, but I'm just doing observations. All we did was change the assumption about inventory. This number here is the only one that changed. And it had the effect of reducing the amount of assets we need to increase. It only increased now from 1200 to 1232, $32 as opposed to 120 previously. On the section here, we no longer need our line of credit because we're generating cash flow sufficient to pay our way. And the other thing is that we are able to pay a bigger dividend. Since we now have excess cash flow, our dividend went up. So we went from $200 to $224 because our profit minus the payout was higher. If we look at the income statement, and this is where we'll see where the dividend is dealt with explicitly, sales went up by 10%, got that. This is the change, 89.5% of sales. The PP&E formula was the same. The 8% on the bonds was the same. We now have no issue with line of credit, so that's zero legitimately. Pre-tax of 136, 40% still is our tax rate. So our net income is 82, which is substantially better than last year. Our desired regular dividend is 10% growth over the prior. The prior was 20, so we'll grow it by 10% to 22. But we have extra money lying around. So we could actually increase by $32 the amount paid in order to pay out the excess funds. And so the additional retained earnings is $24. How we identified these changes is first we had increase in spontaneous liabilities. That was $8. We had no changes in common stock or long-term debt. We had no drawdowns on line of credit or in the past or today. And so we had net income minus the regular dividends. That was $24 we just saw, how much we generated from running the business and handling the balance sheet. The increase due to financing was $68. So the net increase in total assets is 32, which we saw earlier, went from 1200 to 1232. And so the amount of deficit is 36. In this case, it's a surplus. So we're going to actually use all that surplus and pay a bigger dividend. So that's kind of going at it the other way, like from a net standpoint, what happened during the year. Now, we didn't have to do this by paying a special dividend. We could have repurchased stock, we could have repaid some debt, the $500, or we could have bought some marketable securities and add or start building a war chest for rainy days or for an acquisition.